Thank you for the invitation to talk about the misclassification of bond mutual funds. My name is Huazhi Chen, and this is joint work with Lauren Cohen and Umit Gurun. Market participants have come to depend on information helpers to summarize the numerous data points available on assets. This may be especially true in both the bond and mutual fund markets, where there is a wealth of disclosure and information being produced about each asset. These information helpers may be beneficial on average, but their sophistication and their ability to process complicated data will end up affecting how investors perceive risk and behave. We find in our main result that due to their own constraints, a large information helper in the mutual fund space misclassifies bond funds in accordance to their credit risk. The misclassification affects investor behavior. We find that investor flows to bond funds seem to be determined not by the risk indicated by a bond fund's holdings, but by its self-reported risk, which is oftentimes understated. So mutual funds are a topic that needs very little introduction in terms of their importance. There's $46.7 trillion outstanding globally in mutual funds. $16 trillion are invested in America's mutual funds, and an area of recent growth and importance is the fixed income funds. There's about 2,000 dollar-denominated US located funds alone. And now this picture over here that I drew is kind of our prior when we started thinking about the information structure of this space, right? These funds, Franklin Templeton, PIMCO, T. Rowe Price, release information through their prospectuses, through their NQ and NCSR forms that include their filings, their holdings. And investors acquire information from these disclosures and decide whether to invest in these funds. However, when we looked into public access logs on SEC's Edgar server, we found that investors rarely access these disclosures directly. We believe that the reason for why this is that there are important information helpers working in this market that guide investor flows. And you can picture information helpers as kind of an overall class for pension advisors, 12B1 fund advisors, Bloomberg, and foremost, Morningstar, which is the largest information helper in the mutual fund space. Morningstar collects information, some of which are surveys, some of which are derived through mandatory disclosures from mutual funds, and present them to investors. There's a lot of work that's done in this area, especially on equity funds. Evidence from Nanda Wan and Zen, Ben David, Lee, Rossi, and Song, Evans and Sun, and many others have found that Morningstar ratings really actually matters in terms of driving investor flows. Recent work by Hartzmar and Sussman show that even in ESG ratings, that information intermediaries really matter. One thing that we do show in this paper is that in the fixed income space, this information helper really matters. But more importantly, this is an area where sophistication of information helpers matter. Equity funds predominantly hold the same security type, common stocks of IBM, Apple, Microsoft, etc. However, for fixed income funds, each issue differs in yield, duration, covenants, etc. And even across the same issuer, so making them much more complicated to aggregate. So the average active equity fund holds maybe 100 positions. Out of those 100 positions, maybe top 10, top 20 really dominates everything, while the average fixed income funds hold over 600 different issues, each with a sizable kind of percentage of the fund's capital. While SEC mandates disclosures of the portfolio constituents, the data is much more complex and more important in their aggregation itself. So here's a sample of the SEC filing from a bond mutual fund. We took this from the SEC website, right? And you can see that for a lot of different holdings, they actually, in terms of kind of their size, their portion of the total size of the portfolio, it's kind of very similar. And this spreads across the numerous different filings that I'm showing you now. And here zooming in on their hotel, restaurant, and leisure filings, right? McDonald's would issue multiple different bonds in this portfolio, each with a different yield, different duration. And so, these are complicated information that investors really just don't directly appreciate. And these characteristics are very important in the market for bond mutual funds by investors. So this is where we believe that Morningstar really matters in terms of summarizing their characteristics. Our main contribution is that we show the way in which this information helper summarizes this exact same information held in the filings available really matters to investor flows and investor fees. The presentation of these verifiable information to Morningstar shows a wide heterogeneity. So for the same kind of type of credit risk, right, different mutual funds will issue different types of kind of credit risk summaries to Morningstar. These heterogeneity in the summary information ultimately relates to investor behavior. So this is kind of the summary of our main kind of point, right? Our paper provides the first systematic study of Morningstar's relevant data to fixed income investors. Over here, I have kind of a direct screenshot from Morningstar Direct that summarizes credit quality, how much information or how much holding is in AAA rated assets for each of these funds. And we can see that there's actually two different credit quality summaries. There's credit quality, AAA percentage, and then there's the calculated credit rating, AAA percentage. And what we found is that these two numbers just don't agree with each other, right? Sometimes differing by wide margins, and sometimes verifiably different, because we know that these funds hold AA assets that's verifiably AA rather than AAA. And when we compared these two numbers, we found a very wide skew. So we could plot the number for credit quality AAA, right? The distribution of the difference between these numbers. When we dug into these information, what we found was that this AAA number is the credit quality information used by Morningstar and classifying the credit risk quality dimension of these mutual funds. And starting in 2017, they began calculating their own AAA asset. So the first number is the surveyed AAA asset that these different mutual funds report to Morningstar. And then the second number is what Morningstar calculates themselves. And what we see is just this wide difference in terms of distributions. This gap is asymmetric, and average diminishes the perceived risk profiles of these fixed income portfolios. And the gist of our paper is to understand which of these numbers is correct, right? And what in fact really summarizes the credit risk, and whether these differences between the reported and the calculated asset compositions really matter. So if the existing literature hasn't convinced you that this particular information helper, Morningstar, matters, this slide should help. There's really only one place to go for mutual fund data. This is a screenshot I pulled from fidelity.com. Its data is also provided for Morningstar. So it is a very important information aggregator in the financial markets. In the rest of the presentation, I'll just try to establish three main points. We'll show that for many mutual funds, the survey data is different from the credit risk characteristics that both Morningstar and us can reasonably compute using the underlying holdings. So we like to show that more misclassification occurs, right? And we show that there's a persistent gap between the asset compositions Morningstar receives and what they calculate and what we can verifiably calculate using standard credit rating assumptions. We'll show that now this gap characterizes risk. Funds that are misclassified or funds that we believe to be of high credit risk but is reporting a low credit risk are actually riskier than their peers. So we can look into yields, we can look into coupon payments, we can look at realized returns, and these all reflect higher risk in these misclassified funds. Returns reflect especially higher potential risk in the fact that these misclassified funds perform very poorly when low credit rating assets perform poorly. And lastly, we'll try to demonstrate that these misclassifications matter. So these misclassified funds have more Morningstar Stars than peers. They have higher expense ratios, and investors seem to drive flows into these misclassified funds over similar quote unquote investment grade mutual funds. So Morningstar directly surveys fund characteristics from fund managers. This is a survey that we obtained from Morningstar of the actual kind of questionnaire they ask funds every month and every quarter. They directly ask these fund managers for specific dates, survey dates, the percentage of their assets that are in AAA, in AA, in A, and BB, B, etc. Now, it wouldn't matter if these credit risk profiles are just fed to kind of researchers, but Morningstar uses these composition numbers to form their kind of fixed income style box, right? They tell you on average what the average credit quality of these funds are. So on the y-axis are the credit quality dimensions. They also take the average maturity and durations of these assets and form a risk profile on the interest rate dimension. But if on average these credit rating compositions, through their formula of aggregating these compositions, if on average, right, the aggregation says that this fund is on average holding AA assets, it's kind of a AA portfolio, then Morningstar directly kind of assigns these portfolios a AA kind of fund style, right? They call it a AA bond fund. If on average these credit risk compositions are low, then they will assign this fund a BB credit profile, or somewhere in the low credit quality box. And Morningstar began kind of internally calculating these credit holding numbers since 2017, and this offers kind of a unique check on the self-reported data against what's verifiable in the holdings. And we can just plot, sum up the AA assets, the AAA asset, the A asset, and the triple B assets, right? To see how much of a fund is reporting their portfolio in investment grade assets, and how much the fund is actually verifiably holding investment grade assets. And this is the histogram of the reported minus the calculated investment grade holdings. What we see is just a reflection of what I showed you before in AAA assets, right? Funds tend to report more AAA assets than what can be calculated from their portfolio holdings. And an exact kind of mirror image is in their non-investment grade holdings. Morningstar uses these numbers as kind of an aggregation into classifications for bond mutual funds. And on here, I drew 3 different bars. In the green, in the blue are the histogram of more mutual funds in the different categories. And orange is just the replicated number using the surveyed compositions to kind of calculate the average distribution. And what we see is that if we use the survey numbers, we get almost exactly the official kind of categories from Morningstar. And so they're just using these numbers directly to calculate what type of categories these funds belong to. However, if we use the Morningstar calculated numbers, right, what we see is the gray bars. So in the gray, we see a lot less AAA, a lot less AA, and a lot less A, BB assets. They're just a general shift toward the right of the distribution, that these funds are on average of a lower credit quality if we use the directly calculated holdings. And the rest of the presentation, the paper, is just to show, trying to understand which of these bars are correct, right? What's shown and what's reported to Morningstar, or what's kind of verifiably implied by the holdings. So, to do this, we have to directly examine the holdings. So we obtain holdings data from Morningstar, from quarterly filings. We obtain as much credit ratings as possible. So we get all the XBRL filings. Dodd-Frank requires all the credit rating agencies to release their rating history since June 2012 into XBRL filings, and we process those. For days prior to that, we take Mergent FISD, which is a standard database, and Capital IQ for the entirety of the S&P rating history. In the case of aggregating multiple ratings, we use the standard method, the Bloomberg-Barclays method of aggregation, which is actually what Morningstar originally requested these fund managers to use. And we can reclassify bond mutual funds according to their actual risk. So we can assign them into the various high credit risk, medium credit risk, low credit risk categories according to Morningstar's formula. Since 2010, the formula became very stringent. That is, if you hold a lot of junk bonds and you hold the majority of your assets in AAA, you can't get the scoring changed so that you can't really just average on to a AAA asset. So they assigned it a nonlinear score, but then because it became difficult to be a high credit quality bond, right, we see a lot more misclassified funds out there. And on average, we can take the number of misclassified, so which we assign as funds that we think belong to the medium credit quality when it's officially a high credit quality, or if it's officially a medium credit quality fund and we believe it's a low credit quality fund, and we call them misclassified. So these are the number of misclassified funds out there. And next, we're just going to take a look at what characteristics these misclassified funds have. So we can regress misclassification on yields. On average, we see that misclassified funds have higher reported yields. They have higher calculated yields. And if you don't believe in these kind of forward-looking metrics, then we can just look at realized yields. And in every one of these regressions, it shows that these funds on average have higher yields than their peers. Now, if we take a different control, if we compare them to similar funds by holdings, right, then we actually see that misclassified dummy loses all its power. So on average, by assigning them to kind of the correct peers, we get rid of this misclassified yield. So on average, these misclassified funds are, more likely matches the yields of peer groups that we believe they belong to. We can look at return characteristics. On average, right, they have higher returns compared to their official peer groups. But then if we compare them to our calculated peer groups, this abnormal performance disappears. In fact, if we look at the performance of junk indices, right, so junk ETFs, if junk bonds are performing poorly, these misclassified funds perform poorly. If junk bonds are performing well, then these funds are performing well. If they're performing normally, they perform very well. But then they only perform poorly when compared to their official peer groups when junk returns are poor. We can look at Morningstar Stars, and on average, because Morningstar Stars really are based on returns, they have higher stars than their peers. So on average, they have higher 3-year, higher overall stars. And we can look at expenses. They have higher expenses on average. And we can look at investor flows. So over here, I have just the same type of regression. For some reason, fund investors tend to like misclassified funds. So they tend to, on average, have 6.37% higher flows than their peers. And if we divide this by the unconditional probability of positive flows, which is 15%, we can see that these misclassified funds increase their probability of positive flows by 13%. And we have some evidence that these misreporting is related to past returns. So on average, if 3-year returns are good, then they don't tend to start initiating misreporting. They tend to stop misreporting, and they tend to, and if you take the difference of the two, it's the combination. So when we updated our draft, we put it on our website, and it kind of got a lot of press. But one of the nice things is that Morningstar started responding to us. And I just wanted to go over just one last comment, which is that Morningstar sees other reasons for data disagreement. They believe that swaps on treasuries and anything fund manager believed to be highly rated So that is why they use the survey data rather than their calculated data. And because unrated assets are punished in their formulas, right, they think that the survey data is better. But then, if we think about these actual reasons, right, forward swaps are not investment grade assets. It actually loads up on the yield curve risk, right? And we automatically assign GSE, so government sponsored entities, AAA ratings when we calculate our rating formulas ourselves. And then in terms of kind of unrated bonds, right? On average, bonds are unrated because they can't get an investment grade rating. So as a summary, investors rely on external information intermediaries to kind of lower their cost of information acquisition. But then, these information intermediaries really have to be able to perceive risk and be able to interpret risk. Right? So we believe that our study is kind of a first step to think about a market design in which these information intermediaries actually have more incentive to kind of perceive risk and better package the information they gather from market constituents rather than kind of lowering the cost of information acquisition themselves. So thank you very much.
Okay, thank you very much, Chen. Yeah, okay, now we have Melissa Prado from Nova School of Business and Economics. She's going to discuss this paper. You have the floor, Melissa.
Okay, first off, let me thank the organizers for inviting me to discuss this paper. So it's a paper that I was meaning to read a long time. So in that sense, this gave me the perfect opportunity. Also wanted to go to Stockholm in the spring, but unfortunately that was not possible. But hopefully someday this conference will be done again live, and I hope again I'm volunteering. My discussion qualifies me again for that as well. So first off, it's a very interesting paper. It's an important paper, and I think it's really the first paper that starts to sort of show that Morningstar classifications, if taken from the sort of self-reported categories that the funds give, are basically understating the actual risk that these funds are taking. So let me briefly, very briefly, sort of summarize this paper. And as they say, sort of a picture says more than 1,000 words. So I borrowed this from the paper, which is the figure 4, which also H showed in his presentation. And it's a very cool picture that effectively shows what this paper is putting out there. And that's that bond funds systematically overstate their risk category as reported towards Morningstar, as compared to the holdings that they have, right? So what you see here are 3 sort of bars. The blue bar is the Morningstar assigned category, and that goes obviously from AAA to B. And then the gray bar, which is the other sort of interesting one, is the one that you can basically calculate based on their underlying holdings. And what you see is that funds in general tend to sort of classify themselves more so in holding a AAA category bonds and AA category bonds, so the high investment sort of grade categories, as compared to their actual holdings, right? So in their actual holdings, they tend to hold more of the lower credit rating sort of bonds than what they categorize themselves to be. Now, why do they do that? Why do they overstate their sort of credit worthiness in terms of the investment objective that they're following? Well, first off, it makes the funds look much more attractive, right? So because you're, as an investor, naive investor, if you will compare them to funds that are of the same category. And obviously, since they hold riskier assets, they do better if you don't control for their underlying risk in their holdings, right? So these funds look much more attractive as compared to the same sort of risk category that they self-report with, and they're basically misrepresented in terms of the return that you sort of get if you were to compare them with their actual peer group based on the underlying holdings. So they look much more attractive to investors. They look like they're delivering higher returns. And this obviously also makes them likelier to get star ratings, which, as the literature has shown, is very important to attract investor flows. Okay? And this all in turn allows them to also charge higher fees. And the type of funds that are doing this are the worst performing ones. So if you look at the past 3-year returns, then the ones that are doing poorly are the ones that are likelier to engage in this type of behavior, which tends to suggest that it's very strategic in nature, right? To misreport this type of risk classification. And the paper, I really enjoyed reading it. I think it's a really good paper. It's the first to highlight sort of this misreporting, and also to highlight the importance of financial intermediaries and their incentives as to successfully or sort of truthfully report and provide information to a particular group of customers, which in this case would be retail investors. It's also probably the first paper to ever piss off Morningstar, which in that the way they reacted to the paper suggests that they really have to rethink a little bit in terms of how they calculate these things, and should be open towards improvement. And hopefully this paper gets them to do that, and in that sense has key practical implications, and really is a sort of a benefit to society at large, if you will. So it's also very well written. It's an easy read, and it has important practical relevance in terms of highlighting that having a monopoly in terms of processing information on behalf of retail investors does bring about responsibility, right? So in that sense, Morningstar should definitely take a closer look and reevaluate the way they're doing the things that they are doing. So overall, sort of my discussion is centered on sort of a couple of suggestions in terms of what I think could plausibly also be alternative interpretations, or sort of suggestions as to why you observe the results that you observe. I am sort of very sort of willing to believe that these funds are acting strategically. So in that sense, these sort of suggestions are there for you to sort of rule out sort of alternatives and make it a stronger case as to sort of show that funds are strategically doing this type of behavior. So my first suggestion is centered around whether these Morningstar ratings are effectively causing this type of behavior, right? So are they driving the need to misrepresent? Okay, and this is something I'll elaborate on in the next slide. Then I'm going to sort of think about what is the role of rating downgrades, and could it just be a very simplistic and naive interpretation that funds are very sluggish to readjust sort of their reporting when their underlying holdings get downgraded? Okay, so that's something you could look into. Then I was wondering, what's the role of security lending? So bond mutual funds are increasingly, particularly as of 2010, engaging in security lending. And by doing so, sort of there's a transfer of ownership. And I was wondering how that record works in terms of what they have as official holdings versus what they effectively perceive themselves to hold. And that is something that needs to sort of be looked at. Then one minor thing is, so what happens when ratings are assigned, if a bond has multiple ratings and you follow the standard approach, like the Bloomberg ratings approach, but that's also the more conservative approach. Could it also just be that funds are more likely to always go for the most favorable ones? And this, in that sense, would be driving sort of why there's more misclassification for these funds. Now, this latter one is quite easy to do. You just focus on the ones when there is no disagreement in the rating agencies and show that your main results go through. So it's literally just a robustness test. Now, are funds effectively reaching for these stars? Is that the reason why they engage in this misreporting, right? And to actually answer that question, what the paper would need is to provide a little bit more of a causal evidence of the Morningstar classification being the reason as to why funds are strategically misreporting their risk classification, right? And I was thinking about how can you do this? Well, first off, you can show how close are they to losing or gaining a star, if you will, right? So if they're very close to losing a star, are they likelier to engage in that type of behavior? And then for a little bit more of a causal evidence, you could do a regression discontinuity design around that threshold and basically compare funds that are that barely get the star with funds that barely did not get the star, and see whether there is indeed a difference in the likelihood of engaging in this type of behavior. So that would be a little bit more in depth into why funds are doing this, right? So are they facing perverse incentives because of that Morningstar classification of stars? And if so, that's also why Morningstars obviously might be a little bit defensive when it comes to the conclusions of your paper. Then I was wondering, and I'm sure this doesn't explain all of your results, but I was wondering whether downgrades have an important role in what you find. So an alternative interpretation is that funds are just very sluggish when it comes to reporting downgrades. So they face a downgrade in their holdings and they react with it with a delay. So what is basically sort of the actual time frame as to when are holdings reported with Morningstar, when are sort of holdings officially reported, and when are the classifications or the self-reported sort of benchmarks, if you will, sort of made public with Morningstar. So literally what the paper is a little bit missing, in my point of view, is a bit of the timing of when exactly all of these things occur. So are there different snapshots in the same quarter, in the same month, or are they at a sort of contemporaneously taking place, which again would strengthen your results? Now, what also happens with the Morningstar holdings data is that some funds report monthly and some funds only report quarterly. Now, I was wondering if some of these sort of high frequency funds are more prone to have these types of mistakes because they are sort of reporting on a voluntary basis, or maybe less prone. This might be sort of some difference that you can explore in the data by looking at those funds that more regularly report versus those funds that report only on a quarterly horizon. Then I was wondering, what about security lending? So we know bond funds engage in security lending or repo agreements, and sometimes they do this to upgrade their collateral. So they have as holdings maybe less than investment grade bonds, and they want to sort of engage in a repo or security lending agreement in which they swap it for a high quality collateral. And that is also something that, for example, Bay, Agavan, Levin find in the paper in the JFQA, which is called collateral upgrade. So I was wondering, if funds engage in this security lending, can that be a reason why they misreport? Because sort of they might have sort of as collateral superior underlying holdings. Okay, so it's important to rule out and maybe just focus on those that are not allowed to lend, and this is, or not engaging in security lending, to show the robustness of your results, and that this sort of mechanism is not what is driving your results. So how would, in general, security lending impact the holdings record versus the ownership? I know that security lending is a transfer of ownership of a security, but then how does that translate into holdings? Do they report the collateral, or do they still maintain reporting their actual portfolio holding? And this is something that that needs to be clarified to figure out how this could result in misreporting as well. by ruling out these sort of alternatives, it just makes the paper stronger in terms of pushing that this misclassification is strategic, right? So the paper does a good job in showing a sort of the consequences for performance. And if you compare it to the different benchmark, it shows basically that they're underclassifying themselves. But what I want is a little bit more of a causal evidence as to why they go into different categories, and basically get a better understanding if it's really strategic in nature, as the authors claim, by ruling out these sort of alternatives that I just suggested. Overall, it's a really nice paper. I highly recommend you guys to read it. It's a solid contribution to the literature. It's an important topic that has important implications, obviously, for the information that retail investors face when they're looking at these classifications. So all in all, it's a great topic, and I think the paper will definitely end up in a top journal. The only thing that I would suggest to do is look at these alternatives for misclassification to really push the strategic nature and intent of these funds.